please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
UTI Mutual Fund and CNBC TV18 took the 9th edition of the Financial Advisor Forum 2017-18 to Patna in Bihar. This year's theme is riding the next wave of mutual fund growth, megatrends, opportunities and strategies. Industry experts shared insights on mobilizing young India towards smarter investing, use of technology by financial advisors, managing investor money through market volatility, and increasing mutual fund inflows from smaller cities. Good evening, ladies and gentlemen. Welcome to the Patna edition of the Financial Advisor Forum 2017-18, brought to you by UTI Mutual Fund and CNBC TV18. I'm Ridu Bhandari. So without wasting any more time, let me invite all the panelists on the stage. Naresh Pachisia, Founder and Managing Director, SKP Securities. Ashish Goyal, Founder and CEO, Vista Wealth Consultants. Neeraj Agarwal, Director, Simage Group of Institutions. And Suraj Kele, Group President, Sales and Marketing, UTI Asset Management Company. Let me begin by asking you, Suraj, the theme for this year is riding the next wave of mutual fund growth. And I'm going to ask each one of you for opening comments. What is that one mega trend that you see driving the mutual fund industry in the next financial year? The one trend that you think the IFA should be watching out for?
To look at the RBI report on household finances. So recently in August 2017, this report has come out, and the idea of this report was to just look at household finances and how they are structured. Right. Now interestingly, when you look at Indian households, we have 95 rupees out of 100 in physical assets. So essentially, you will have real estate, which is a large component of it. You will have durables that you buy, and in addition, about 11% in gold, and only 5 rupees in financial savings. Now, just imagine, if you can really transform this, because if you look at global markets like the US, there you have about 56 rupees in physical assets and 44 in financial assets. So in my view, this theme of financialization of the economy is such a big mega trend, and it can really help all of us in this room here grow our businesses very significantly.
Okay, financialization of assets. What about you? What do you think is going to be one trend that's going to be big in the next financial year?
The mega trend which I see is, young people, young earners are now looking at mutual fund. They discuss in their groups. I'm part of a lot of WhatsApp groups, Facebook groups, and even in the parties, they discuss about whether you have invested or not. And in this, Mutual Fund Sahi Hai campaign has really helped.
Naresh, what do you think?
I completely endorse actually this is the key trend of financialization of investments, because people are realizing that they really do not help you create wealth. And particularly the younger generation, as my colleague was saying over here, they do not believe in gold as an asset class for investing. It's there for only hedging purposes. And on the other hand, real estate, it's not good for investment as such. And equities in a growing economy like India, for example, if you were to try and see as an asset class, equities is going to reflect the economic growth, not real estates. So I think we are going to see this trend increasing in leaps and bounds as we grow, particularly with the new generation coming in.
Neeraj, what's your one mega trend to watch out for?
The entire growth story of India, that is one theme, I think, which will take the mutual fund industry much ahead. And the growth story of India is completely intact. We are the fastest, one of the fastest growing economy in the world. And if you want to take advantage of the fastest growing economy, mutual fund is one segment through which you can ride the wave.
As far as the mutual fund industry growth is concerned, Ashish, is it time to tame investor expectations? Because after last year, the expectations are pretty high.
When they are coming in, very important for all participants, market participants like manufacturers, distributors, even regulators, to set the right expectation in the beginning, because that is a foundation stone of anything which will be seen later.
On the awareness front, the Mutual Fund Sahi Hai campaign has had some impact in many parts of the country. But for the IFA community here, Naresh, what are the do's and don'ts? What should they be doing to really promote awareness much more actively?
More and more networking, more and more prospecting, more and more coaching of clients, hand-holding of investors, creating awareness that actually wealth in a growing economy like India, it's not very difficult to create wealth investing in instruments like mutual funds and trying to ride the economic growth to create their own wealth. But the other thing is to keep it very simple and make them feel, not confused with any kind of jargons. I think it's very, very important for financial advisors to actually, not only manage people's expectation, but then look at their entire, counsel them on investment behavior. Because what we have seen is investment performance has not been replicated by investor performance.
Okay, but Neeraj, you operate here out of Patna, so educate us on what sort of investor trends does the city and the surrounding regions have? Are they big on mutual funds yet? What are the preferences?
Actually, it's growing. It's growing very rapidly, in a very rapid manner. Last year, if you see the data, in Bihar, mutual fund industry AUM has grown by more than 50%. That means Bihar is outperforming on a national basis. But if you see, the base of Bihar is very small. And if you do a comparative analysis, Bihar, the contribution in terms of bank deposit is more than 3 lakh crores. That means people of Bihar are still relying on the fixed income through bank or even in post office. So Bihar is in the top 10 states in terms of contribution to post office deposits or saving schemes. So when you see mutual fund industry in Bihar, it is roughly around 15,000 crore contribution to the national AUM. And that means out of 23 lakh crore AUM, national AUM, Bihar contribution is just 15,000 crore. That means less than 1%. And the population of the state is 8.5% of the country. So that means enough potential is there.
The mutual fund AUM from small towns grew by 42% in the last 1 year alone. So Suraj, do you see the B15 cities contributing much more going forward? And what's your advice to IFAs for tapping newer markets and reaching out and really expanding the geographies they operate in?
So I do believe that a lot more has to be done in this area, right from building awareness to building distribution, making people understand the merit of these products. So even when you look at various segments, so there's only one segment that seems to be coming to us, primarily maybe the salaried class, but what about the small businessmen who operate in these cities? What about the retirees in those cities? So actually, if you look at the marketplace, whether you do it by segments, you do it by the kind of products they should buy from us. So today, if I'm sitting here, chances are that everyone here sells equity and balance funds, because that's really where B15 incentive matters the most. But when it comes to, let's say, debt funds, the penetration of debt funds in B15 towns is so low, and obviously there the schemes cannot absorb, even that 30 basis additional that is paid out. So obviously I do believe fixed income is a great product to really take to your investors and get them started.
So as far as the mutual fund industry is concerned, Ashish, what are some of the best practices that you would like to share with the IFA community here to leverage technology better, both in terms of maybe back-end operations, plus in terms of enhancing the customer experience, because today's customer is quite tech savvy?
Do look at small things which were not there earlier, like it could be mobile app, because now we have portfolio logins and they can go and see on their website, our website, but probably they want on the app now. They want to see how much goal is achieved, what is the impact of the market. Though we don't recommend them to see it on a day-to-day basis, but they want the empowerment to see it. Once they see it and they see they are in control, so they like it. And they do talk about to other friends and other people. But the other important part, which I call tip, is very important: trust. It is not that only technology will build the trust. You have to build yourself.
That's some sound advice. But out here in Bihar, Neeraj, you are also mobilizing the youth. You're into educational workshops, educating them financially and inculcating the savings habit amongst youngsters. So how are you doing that? Are you using technology in a big way?
We are staying in Patna, and most of the AMCs are having their offices, CAMS is having an office and all. But the one who is staying in the semi-urban towns, for them technology has become a big enabler. they can, from their own convenience and ease, they can log in and they can punch in their forms and everything. So technology is one thing through which advisors are riding the boom.
So, two big questions that any investor really has is how much to invest and where to invest. So, your tips, Ashish, to IFAs on asset allocation and portfolio diversification, and do you take the help of technology on that front at all?
We call it basically a peer model. The peer is first is portfolio matching with the exact requirement of the client. So let's say client has 4 dreams, requirement of things. One is 3 years, one is 5 years, one is 10 years. So you have to choose the right product which is matched to the right requirement. First, other things which we do is do the E, which is expectation model. Expectation basically. So we have to manage the expectation. And third is the emotion behavior. We have to manage the emotion. Client asks us, why should we do it through you? Because we say, because your biggest and the most potent enemy is your own emotions. So we will give you the right thing, right product, right path to follow, but your own emotions won't let you do it. Many a time we give them form and the client give the risk, this is, I will do this, and we give them risk, profile to the client. Accordingly, we allocate the things. But there is another important thing, risk profile. The other is risk tolerance and risk capacity. All these 3 things, boils down to the fine judgment when you are interacting with the client. That cannot be taken over by technology. The human aspect, the touch aspect, the care cannot be taken. It is making your job easier, but that aspect cannot be taken by the technology. So if we follow that peer model, PEER, it is working wonders for us. And clients do come to us and say after that, yes, I was telling you I wanted to invest in equity, but my risk profile was, and my risk tolerance is not that big. Right. So we have to be very particular about small things.
First-time investor in particular is very apprehensive of market volatility and investing in market-linked options in the first place. So what's your advice to IFAs? How do you handhold first-time investors in particular across age groups through this?
Whenever I've met with first-time investors, I think the biggest way to win trust is to accept the volatility of the market. So sometimes we have a fear that, oh, if I tell him the markets can correct by 15%, the investor will run away. No, that's not true. In fact, it's worse, because if you tell him that you'll get 15 and then minus 15 happens, then they certainly run away for good. So my first bit of advice there is that be absolutely straightforward to your investor. I think they appreciate it. The good news is that the new age investors in particular are willing to reason with you. They are not coming with any artificial expectation. They want exactly how that product has to be utilized. The second aspect, which I think I always do with first-time investors, is I always tell them that if you're not, let's say, in a savings habit, so don't start with just a tokenism of saying, okay, I'll save 1,000 rupees in an SIP. Because the reality is that if 1,000 rupees compounded for 30 years, right, grows to, let's say, at 12% to 25 lakhs, if you would do 10,000 rupees, it will go to 2.5 crores, right? So it's very important that you increase your marginal rate, and highlighting that to the investor that the biggest delta he can get in their, or they can get in their portfolio is by how much they save. It's not about just the returns which matter. So this combination is what generally I recommend to first-time investors, that save a larger amount, save as long as possible.
Naresh, you advise some leading family businesses and institutional investors. So share with the IFA community some of the lessons that you've learned along the way. How can they tap these particular investor segments better?
In my experience, the salaried people are the most disciplined investors, and business fraternity and professionals are actually not that disciplined, because their cash flow is not disciplined, their savings are not disciplined, and they are not regular. So I think one of the biggest mistakes that most family businesses, particularly small family businesses, do is that they, and what you can advise to them is to create a wall of China between family wealth and business capital. And this, not being able to distinguish between the two is the biggest problem family businesses have gone through, in my opinion, because normally family wealth is for a longer term time horizon. And that's how you can invest family wealth in instruments which are long-term in nature. However, business capital, normally the requirement would be short to medium term. And so you need to have liquidity and all that. And one thing about creating that trust is, actually we, first-time investor or to anybody, is to actually not promise them something which is not in your control.
One of the big changes that has happened in the recent times is, of course, in this budget, the introduction of the long-term capital gain tax on earnings from mutual funds, and that's a query that almost every investor has brought up post-budget with his or her advisor. So, Neeraj, what's your advice to the IFA community to, one, dealing with these queries, and two, also a lot of investors are now looking at ULIPs as a better option than they were in the past.
IFAs are not just for the mutual fund distribution, they are for some solution providers. So for the investors, for planning their taxation and for planning how to minimize the taxation liabilities, IFAs has to play their role. And as far as the long-term capital gain taxes are concerned, I think the way you are, the question, as far as ULIP versus the mutual fund is concerned, if you stay invested in a mutual fund, your effective rate of long-term capital gain taxation in long term is much less in comparison to mutual fund, because whatever long-term capital gain tax will arise only when you liquidate or only when you exit from the fund. So in case if you are staying invested, that means whatever taxation liability would have been created, that is also earning while you are invested.
The other big step that SEBI is mulling over is the demarcation of mutual fund advisory and distribution. Naresh, how do you see that panning out in the future? How should IFAs be gearing up for it? And do you see a lot more competition from direct plans?
So much of under-penetration, so much of investors who are not initiated into mutual funds. Now, how do you actually sell a fund which is desirable to be sold? So I would suggest that we should do well to actually continue trying to penetrate the market further, reach out to more and more investors, convert India's savers into investors, into financial instruments like mutual funds, so well regulated otherwise. So I think that's more important. It's all about priorities, and if that's true, I don't think that we should be touching this.
Let's shift gears and talk a little bit about particular investor groups as well and how each one can be tapped. And we've spoken about youth at length. The other group is that of women. The number of women investors in the country is rising. What are you, as financial advisors, what are the strategies that you're adopting to particularly target women? And is there any difference in strategy for the woman's psyche at all?
Women, in my opinion, are much more disciplined in their approach towards investing. They have less volatility in their thought process about investments. They're very objective, and maybe at times a little more defensive than required, or a little more risk averse than required. But they have the patience and persistence and the discipline to actually make it big through their investments and achieve their goals. Once they understand, then there is no stopping back.
Thank you very much, gentlemen. It's been a very, very insightful session, and thank you, Patna, for being such a participative audience tonight. With that, it's a wrap of the Financial Advisor Forum 2017-18. Do watch out for the Financial Advisor Awards 2017-18, India's most definitive platform for recognizing the contribution of the financial advisor community. Thanks for joining us. Goodbye.